Okay, so welcome everybody to this webinar, and especially to all the people that are new to what we do. There are a few of our existing members, so welcome to you guys also. Now, this webinar is the distillation of everything that I've done in the last 25 years, all the learning and all the hard-won experience and all the bruising that I've had in that period of time. So I pulled it all together, and I want to present the most succinct overview of what I've managed to evolve over the years and the way that I currently trade and the way that works really well for me. Now, this is the first time that we've gone public to an audience that's not been virtually exclusively referred to us. I've built my business around a very high level of personal service, which in my view goes way beyond what anyone else in Australia provides or would possibly contemplate providing. I do it that way because after a dozen or so years of observation and involvement in the trading industry and particularly in the education space, it's the only way that I can see to get the maximum number of people to where they want to go. Information alone just doesn't do it, and most people are focused on getting told, giving recommendations as to how to trade, and that's important, but it's not what is going to make you a trader over the long term. And so part of that side of it I want to capture tonight and really reinforce the importance of that for you. Now, we've purposefully sought to keep our business at a level where we could always provide that sort of very personal level of service. It's a family business. It's myself, my son, my wife, and two other super associates that have been working with us for the last year or so, and that's it. So we're a small family business with a very personal service bent to what we do. So let's get stuck into it. I hope you get a lot out of tonight and get a very sharp perspective on what you have to do to trade effectively. There'll be time for questions at the end, and of course some details about the competition as well. So just to start with, just a reminder that everything that I'm doing tonight is under the banner of general advice and general information only. I operate under the Licence of Financial Services of Australia, and so really anything that I cover tonight, and I will be going through some examples, please do not take them as things that you could or should action in the near future. Okay, so there are two aspects to having an edge in the market. The first one is an approach that provides you with a technical edge. In other words, you've got the repeatable process that you use gives you the capability of making more money than you lose. And one of the realities of trading in the market is that you do have losses, but your approach needs to allow you to obviously make more money than what you lose. And more than that, it's got to be effective through all kinds of market cycles as well. And markets these days are far more volatile than what they used to be, and an approach that works in a bull market is unlikely to succeed in other kinds of markets, be they sideways or downwards kind of markets. So the approach that you take needs to have flexibility, and it needs to be effective through all kinds of different market cycles. And really the only way to learn that skill is just to go through those market cycles quite a few times, because every time you go through a particular bull market or a bear market or a market crash, and I've been through several, you learn new things and you gain new perspectives. And I first started my trading career just before the crash in 1987, so I've been through a lot of pretty tough and volatile markets. The second thing is that trading is not about certainty, it's just about probability. And I still talk to a lot of people that want some kind of certainty around the information that I'm giving them, and trading will never be that. It's only ever about probabilities. It's definitely not a perfect science, but it's one where if you know what you're doing, you can use probabilities to a very great effect. So that's the first part of your edge. It's having a technical entry-exit approach that works. The second part, and probably the more important part to my way of thinking, is that you've got to have a strong support process that allows you to apply that edge over a long enough period of time so that you start to understand what it is that it is required to make money in the market. We're all naturally hardwired emotionally to make emotional mistakes. We have the tendency to experience fear when market prices are falling rapidly, and we have a tendency to get greedy and feel elation when market prices are going up. And they're really emotional responses that get in the way of clear thinking decisions. So the aim of a support process is to keep you in the game long enough so that you can overcome those natural inclinations. So really the support process is about, over time, helping you change behaviours. And unless you embrace that change of behaviours, you will never, ever, ever make money in the market. And I can promise you that with absolute certainty. And I know most people don't want to know about that sort of thing, about the behavioural change sort of thing, but unless you are prepared to embrace it, you will always be a victim of the market and you'll never be a success in the market. So let's have a look at the first part now, the technical trading edge. And I divide up the market opportunities that I look for into 4 distinct areas. And the first one, as anyone that has had contact with me in recent times would know, that I'm always banging on about reversion to the mean, and that's just basically an inescapable law of financial markets that works really, really well if you know how to apply it. And I tend to use it in 2 contexts. The first context is in strong uptrends, and I'll show you some examples of this in just a moment. So strong uptrends is the first context. The second context is where quality stocks, so I'm talking about high quality businesses, not speculative punting stocks, but high quality stocks that have been unduly sold off because of short-term sentiment reasons. There is a tendency, a very strong tendency, for that price to then rebound to what we call the mean. And I then combine that law of financial markets with various other tools that I use, various other momentum indicators, and especially price patterns. And that's a skill that I've developed to a fairly great degree over the last 10 years, because I just spend so much time. I look at literally thousands of charts every week, and when you look at that many for 10 years, you actually pick up a few things about patterns, and you start to notice things that are repeatable and give you an edge. So let's have a look first of all at some examples of using reversion to the mean. So the first one here is a stock called ARP. It doesn't really matter what the names are, but you'll notice here that we've got a rising trend, very strongly rising trend here, from around about $2.50 to the current price of around $9.40, and basically that spans a period from March of 2009. So that spans about a 3-year period. And you'll notice that we've got 2 moving average lines. One's in blue, one's in light purple, and you'll notice that the share price at various points tends to be extended away from those moving averages and will then find its way back to those moving averages. In other words, it will revert to the mean, or the average if you like. Sometimes it does it by just going sideways for 4 to 6 weeks, and other times it does it by actually pulling back in price. Doesn't really matter how it does it, but combined with other tools that I use, that gives you a very good idea of where to buy and, importantly, where to sell. For instance, up here in the middle of the chart here, which was in September of 2010, the price had been fairly enthusiastically pushed up from around $5.40 to the mid $7 area. And looking at the chart patterns and just looking at how far extended that price was above the moving average, it was a pretty fair bet from a probability point of view that that run was going to ease off for a period of time, and indeed it did. It came back over a period of 6 to 8 weeks before it took off again. So there's one example, and I'm just going to give you a roll through a few different examples over different time frames and different patterns just to give you a sense of it. Now let's have a look at CSL. CSL has really not been trending that well over the last couple of years. It's been a bit of a sideways mess, but you'll notice that earlier or late last year in September, the price did start to move, and it moved from around $26 to the current level of $38. And you'll notice at the moment that the price really is quite extended, well above the mean. So to me, the probability is that that price will find its way back towards the moving average at some point in the future. Now, what we don't know is from what price and from exactly where. And that's where other tools basically can be used, other technical tools such as double tops, such as momentum indicators that indicate where prices are oversold or overbought. So that's an opportunity, if you'd bought that stock, to at least be on notice that maybe this is an area where you should be looking at taking profit, for example. But it's certainly not an area where you'd want to be buying. So the next buying opportunity will be when the price pulls back to the mean, all dependent on pattern, of course, at the time. Let's have a look at OSH, and we've got a similar kind of pattern here. This is a stock called Oil Search, and you'll notice that we've got a big picture peak here from April of last year, which is about $7.60. We've had a pretty good trend up over the last few months, and the price now on a daily basis is now really quite extended above the mean. So despite the fact that this is looking very bullish, there's no way that I'd want to buy it at this level, because the odds of further upside as against the odds of downside is actually not anywhere near in your favour. And as I said on the opening slide, trading is very much about a game of probabilities. So there's a possible short sell trade moving into focus here if you understand what short selling's about. Now let's have a look at QBE. QBE's had a pretty wild and woolly ride over the last couple of months. Sold off very heavily in January. You can see there was a massive gap down here and a huge reversal candle where basically the sentiment had gone from being unbelievably negative to extremely positive within the one trading session. That kind of change in sentiment within a single day, plus the fact that the price was way below the moving averages, really gave you a high probability that the price would revert back to those moving averages, which it basically did pretty much immediately. Move on a couple of months and the price has moved up very significantly. There was a little bit of good news and the price probably got ahead of itself, and so at this point, with the price way above the moving averages or way above the means, that was probably a good area to be looking to sell. So that concept of reversion to the mean, and there certainly is a lot more to learn about it than just that simple view, but the concept of reversion to the mean is a very powerful one if you know how to use it. And here's another one, bit of a different format. This is a stock, gold stock called Regis Resources, that must be one of the best performing gold stocks in the world because most of them are doing so badly. And this is on a weekly chart, and basically it's showing you a little bit more than 2 years worth of trading. And you'll notice that it's been a very stable trend, but there's been 5 occasions when the price has got reasonably extended above the moving averages and has basically pulled back to those moving averages, and they've proven to have been a good support and a good entry level. Now, at some point, you notice in this trend that we're getting a run and then we get a small pullback. of maybe 3, 4, 5, 6 weeks. Then we get another run, we get another pullback of 3 to 6 weeks. Another run, another short pullback. But eventually, at some point, there will be a pullback of that whole range. So there are signs that you can look for that will tend to give you a pretty strong idea of when that major trend is finished and that we're actually going to get a more concerted retracement or perhaps a very extended sideways movement. And we've certainly seen that sideways movement in the last 6 to 8 months in gold. We had 34 months of gold basically rising, and now we've had gold basically consolidating and forming a big triangle over the last 8 months. And so there are signs that you can look for, and they tend to be things like you get much higher volatility start to come in. We get some very significant down days or down weeks that are much larger than what we've seen in the past. You tend to see the initial lows get broken. Each time this formed a low, the price went higher, and that low was never broken. But when you start to get towards a major top, you start to see lows get broken. So you start to see a different price pattern. And without going into too much detail tonight, because that's way beyond the scope of what I've got time for here, because to do justice to this whole discussion, I probably need about somewhere between 6 and 8 hours to do it properly. The point is that when you know what you're looking for, those kind of patterns are very easy to read. And this whole thing is built around giving yourself a very significant edge. Now, let's go back and have a look at the second type of trading that I undertake, and that is basically price breakouts. And over the last 3 to 6 months, we've actually had some really good price breakout opportunities. They're occurring all the time, constantly. Even in bear markets, we get price breakouts. But the success rate of those price breakouts is very much dependent on market sentiment. When you're in a bear market, you get lots of little breakouts that might only last a couple of days, and then the majority of them fail because there just isn't enough momentum in the market to propel them. In markets like we've had, particularly in the last 3 or 4 months with respect to gas stocks, the success rate is far higher because it's a sector in favour. A lot of the shorter term traders are trading it with a lot more confidence and risk, and so the success rate of stocks breaking out increases quite considerably. So the success rate is highly dependent on market sentiment, and particularly when you're punting the smaller stocks. You've got a couple of alternatives. One is you can either seek to try and catch that price breakout very early, and sometimes that's possible, but often the price breakout moves so fast that you actually don't get an opportunity to get a reasonable entry point. Or the other alternative is you wait for a retracement, perhaps back to the breakout point, to enter. And in many ways, that's a safer way to go about it. But when you're trading small cap stocks, volume is absolutely the critically important step in this process. So let's have a look at one, and this is a stock called Buru Energy, BRU, and for regular traders here, you'd recognize this stock. As you can see here, we had a long period of basically just moving sideways. There was hardly any volume going through, and then they made some good discovery, and the market started to get interested. Here's our original breakout on the 18th of October. There was some reasonable increase in volume. The market then pulled back a little bit, pulled back from around just under $1 to about 85 cents. Spent probably a week or so around there, and then on the 7th of November started its really good run. And as you can see, ran from around about $1, got as high as $3.80 before it pulled back. So a very, very substantial run. Now, it's not to say that you would have been able to secure that whole run. In fact, depending on how you trade, you may have taken part of that small run, jumped out, got back in again on the next trading signal. There's many, many ways to do this. But the success that you have with these sort of trends depends on two things. One, on your trading style, and B, on just how well organized and how clear you are about what you're doing. And in my experience, most traders are not at all clear about what they're doing. They're just in there with a mass of waving arms and legs, and they're just punting their little hearts out, and eventually the market's going to grab them. But a bit more on that later. Now, larger stocks do tend to run for longer, and they tend to run in more stable trends. So when you get breakouts in larger stocks, they tend to be easier to trade. But I can tell you in the last year or so, there's not been a lot happening in the larger stock space. So many of them have just really been in a big sideways consolidation mess. It's been extremely difficult to trade. Now, the third one, and this is one that really does have a high probability attached to it. It does involve short selling. So if you don't understand what short selling is, we'll have to catch up on that at another time, but this really is a high probability type of trading opportunity. Now, almost never will you know about the profit downgrade before it happens. So that's point one to accept. You can only observe the profit downgrade in arrears when you find out about it either that day or perhaps that night, when you might see a massive share price fall. The volume usually is very high on day one, but after that, volume doesn't come into my thought pattern at all. Volume obviously very important when you're buying, looking for prices to go up, because you need volume to consistent buying to propel the price, but you don't actually need a lot of volume to cause prices to fall. The target is generally a big picture support level and quite often takes several months to reach. Now, the tricky bit is the entry. If you can get the entry right, then these trades work very well in your favour. But getting the entry right and setting it up from a risk management point of view is the tricky bit. So let's have a look at a couple of examples of those. We'll have a look at a stock called Bradken, which has actually just issued a profit warning in the last couple of days. But it's not that one that I want to look at. I want to go back quite a way in time to when Bradken issued a profit warning back in 2007. The price had been trading at about $15. They came out with a profit warning. Basically, the price dropped from $15 to $9 on the open. So it dropped 40%. There wasn't any opportunity to do anything about that. So the entry opportunity occurred after that initial drop. And this is a trade that I actually took. Entered at $9 once I was clear on where the pattern was going and how far this might bounce back. And I exited at $7.05. I'll just type that up so you can see it a little better. I exited at $7.05 about 6 weeks later. Now, that doesn't seem like a massive move, but it's 21.6% gain. And when you're doing that using leverage, which is through CFDs, which is the way that, to my mind, that you would short sell this, then that's actually an incredibly attractive trade in terms of percent return on the amount of capital that you've got to use to actually do that. So that was one really good example. And the point about that is that we didn't have to get, even though the price fell from $15 and touched a low of $6, we only took a bit out of it. We got in at $9 and got out at $7. We only took $2 out of that $9 fall, yet it was still an extremely profitable trade. So it's all about how you structure this process. Let's have a look at Billabong. And there was an opportunity here when Billabong came out with a profit warning back in August of last year. The price dropped fairly heavily from around $5.40, dropped to around $4 instantly. I did a short sell. In fact, that was one that our members participated in. We ended at $3.40 when we sold it short, and we bought it back at $3.07. So we made a 6.8% gain in 3 weeks. But again, with the leverage effect, that was a very, very nice trade. Let's have a look at Transfield Services. They came out with a profit warning in August of last year. After the dust settled for a couple of days, we entered at $2.40. We traded it down. It got down to about $1.70, and then when it started to head back up again, we got out at $1.90. That was a 20% gain in 4 weeks. So these are highly, highly reliable trades, but the entry is a bit tricky. So for a lot of people, you would need a bit of assistance with that. And the fourth area that I focus on in general terms is looking to trade ranges. And these can be reasonably reliable patterns, but one of the phenomena of financial markets, particularly in the last 5 years, with a lot of computer-driven trading, is that we're seeing a lot of false breakouts these days. So you just need to be aware of where you put your stop-loss exits when you're trading ranges, because otherwise you could be stopped out if you make it too tight. So you just always need to bear that in mind. But having said that, the false breakout, once it's confirmed, is one of the very best trading setups that you're probably going to find when the price moves back into the trading range. This kind of trading does allow you to set tighter stop-loss exits, so that's certainly a positive. But trade management is absolutely critical with these trades. So you need to have an approach where you do take some partial profits along the way. Let's just have a look at a couple of possibilities. This is BHP at the moment, and again, this is not a recommendation, it's just an observation of what is. You can see BHP has had basically a base formation here, just a tick under $34. It's tested it on 6 or 7 occasions now, so there's been several buying opportunities, and you can see that it's also had an inclined resistance line as well, where you had the opportunity to basically short sell the trade. Now BHP is not the greatest example to use because of the way that the price gaps all the time, because it's basically trading in overseas markets as well, but it certainly does illustrate the point. Let's have a look at Woodside as another example. We had a trading range that had formed up here, upper and lower levels, as you can see, so provided some short selling opportunities and some buying opportunities. And then we got a false breakout which occurred on the 22nd of February. That looked incredibly positive, and I know a lot of people got caught going long. They bought the breakout of Woodside, and then the price immediately turned around the next day and closed back inside the range. As soon as you saw that happen, it was a signal to go short, and the price has moved down from a bit over $37, been down under 34. So again, a pretty useful trade there. So they are the 4 general trading areas that I look at. Now obviously within each one of those they then break down into various opportunity subsets and different types of entries, but it's very much about the structure and very much about reading the crowd behavior in the charts, which is something that I've spent a lot of time developing as a skill. Now the next part of technical analysis, I guess, is using all the tools at your disposal, and certainly I do use fundamental analysis to a fairly great degree. So just a couple of points on fundamental analysis. Everything that I do, any stock that I look at, I've got a formula and I've got a checklist, and it doesn't matter whether it's a long-term solid company that I might be putting in my superannuation fund or a very short-term speculative stock where I'm not too concerned about the fundamentals, but I'd like to know a little bit about the stock. So whichever it is, I've got a checklist or some form of structure that I can weigh it up against. Now, the analysis doesn't have to be perfect, and a lot of people get hung up on doing the analysis perfectly. There's just no point, because the market can do something completely different in any case. So there's no requirement to be perfect in your analysis when there is no direct link between a perfect analysis and price movement. Now, when it comes to speculative resource stocks, these are some of the things that I look at. Key one is management track record. Have they run that sort of project before? Have they brought it in on budget and been able to achieve their objectives? Obviously, you want to look at the deposit characteristics. You want to look at grade and size and distribution and all those sort of things, mineral processing capability. You want to look at infrastructure, and quite a few of the projects in Africa, for instance, require some very, very substantial infrastructure to be constructed, so you need to know whether that's the case. You need to look at the funding. How much capital has the company got right now to conduct their program through to being able to actually make some money, and how often are they going to need to raise capital, and when will that capital raising need to be? We obviously need to look at the commodity supply and demand characteristics as well. Very, very important to know that you're dealing with a commodity that is likely to be well supported for at least the next couple of years. And if it's outside of Australia, then you certainly need to look at geopolitical factors as well, because there's been a lot of changes in the last couple of years. A lot of countries in South America and in Africa are changing the mining laws. But I mean, having said that, the goalposts are changing in Australia to a pretty disturbing degree as well, so I guess we're not immune from it here. Now let's look at some longer term solid stocks. The sort of things I look at, return on equity is the critical driver for me. It's the number one thing that I look at. And secondarily, I want to see good, strong earnings per share growth. But what I'm looking for above anything else is I'm looking for consistency. I'm looking for, yes, good solid levels, but I'm looking for consistency. I'm not after stocks that 1 year are going great and the next year they're falling in a hole, because it's just too unpredictable. I also look a lot at how a company manages its cash flow. So I'm not talking about profits, I'm talking about the real cash running through the till. And in particular, how they treat their shareholders. You know, how much of that money do they return to their shareholders? How do they treat them? Do they treat them badly by a lot of capital raisings where the shareholders don't have an opportunity to participate, for instance? And obviously, importantly, debt levels are critical as well. So they're the fundamental aspects that I look at. And then, of course, combine that with technical analysis. There is no way that I would ever make any trade or any investment, whatever, unless I could look at a price chart. So I have no interest in IPOs because I cannot look at a chart and be able to gauge price action. So for me, technical analysis is an absolutely essential tool. We make money from prices moving. We don't make money because we were able to do a fantastic fundamental analysis. It just doesn't work that way. So to me, if price movement is where you make your money, then that's what you should focus on. And if you want to look at a classic example at the moment, just have a look at what high quality gold producers have been doing for the last 6 to 12 months. I mean, we've got some fantastic businesses in Australia. There's 8 or 10 high quality gold producing businesses that would stack up against lots of businesses in terms of their fundamentals. Yet look at the share price performance around the world for gold producers. It's been abysmal. So, you know, at the end of the day, it's all about what the price is actually doing. And it always comes back to an entry process built around those high probability chart patterns. And that really is the essence of a trader's edge. Okay, I just want to make a few comments about the market outlook for 2012 for those that are interested in that perspective. Fundamentally, I'm bullish on stocks and commodities at a big picture level. And I stress that is at a big picture level. I am expecting plenty of volatility. So I am expecting plenty of ups and downs, but I would expect that by the end of the year, we are probably going to have some pretty good outcomes at a stock-specific level. At the index level, I'm not so sure, but at a stock-specific level, I think we're going to have some great opportunities. And the reason that I say that is that, you know as well as I do, all around the world, governments are debasing currencies like there's no tomorrow. It's all part of their competitive advantage that they're trying to get in the export market. The US is doing it, Japan's doing it, the UK's doing it, Germany's got a huge competitive advantage at the moment because their currency is artificially low, and you've had China that's been doing it for several decades. So currency debasement, which really is devaluing currencies, causes asset prices, so assets being stocks, property, commodities, to rise because of the eventual inflation impact that that has. Because at the end of the day, assets around the world, financial assets, are competing with each other, and money flows where it is treated the best, where it gets the best return for the risk that you have to take. And that's just the way that it works. The key big picture indicators, that cause me to really be bullish on stocks and commodities, is that stocks tend to do well in an easy credit environment. And we must have the easiest credit environment that there's ever been. Interest rates in other places around the world, not so much here in Australia, but interest rates around the world are so close to zero in the US, Japan, the UK, Europe. So in an easy credit environment, history tells you that stocks tend to do very well. And there's been a 30-year bull market in bonds. Now, if you're not quite sure what that means, I'll have to again deal with that at another time, but there's been this massive bull market where people have been buying bonds for 30 years. Now that market is well and truly past its peak and is rolling over, and on a big picture view is going into reverse. Now all that money that's been sitting in that bond market will start to progressively come out of the bond market. It's happening already, and will start to flow into stocks in America. So for those big picture reasons, I remain very bullish on stocks and commodities for 2012. Let's have a look at America. Housing, just very quickly, housing and debt, still huge problems, obviously. Manufacturing coming back quite strongly, and that's because the devaluation of the US dollar has certainly improved their competitiveness. Corporate profits in general, pretty robust. We've seen that over the last probably 3 or 4 reporting periods. The reporting season we're in right now, a lot of the results are ahead of expectations. Now, expectations were pretty low, so that's not necessarily a big statement, but at least they were ahead of expectations. Interest rates in the US are fixed until 2014, and that's pretty much a given. This is a presidential year. Those guys are going to do whatever they have to do to hold things together for the end of this year. Now, a potential concern is that there are very substantial spending cuts and tax changes that are scheduled to come in early 2013. If you remember back into last year, there was all that debate about about spending and debt, and that was one of the consequences that came out of that. Now, if that goes through, I think it will have a very significant negative impact on the US economy because it will draw an enormous amount of stimulus out of the economy. However, I reckon that they'll just legislate it away. I don't think it'll ever happen. But just be aware that there are some key things happening early next year. Now, let's have a quick look at Germany. Germany's been rolling along very nicely. They've been the beneficiary of the currency, but also because of their own very strong productivity. But I just have this feeling that their currency advantage is not going to remain. Something is going to change, I think, for Germany. Could be a breakup of the euro. Not sure, but I just think they've been getting a tremendous leg up, and it's quite possibly not sustainable. Let's have a look at Europe in general. Debt is still a huge issue for Spain, Italy, and even France to an increasing degree. But I also believe that the ECB will continue to keep coming to the rescue, and I think markets are really moved into that mindset now where they kind of know that the ECB is going to print as much as they need to keep the ship afloat. Let's look at Japan. Massive debt problem in Japan for 25 years. They've got an aging population. The 23-year bear market we've had in stocks and property pretty much says it all about Japan. They're no closer to resolution than they were 20 years ago. And finally, let's look at Australia. This budget surplus debate, unfortunately, has become a real political stunt on both sides of politics. You know, you've really got to be incredibly distraught about politics in Australia at the moment. Now is not the time for extra taxes, given where consumer confidence is and the split economy that we've got, but it would appear that's what we're going to get as part of this political stunt. And unfortunately, I think we are probably getting the government we deserve because there's still a bit too much complacency in this country. So may that change in the future. So what does all this mean for stocks? The important question. To my way of thinking, it's pretty hard to see a rerun of the sell-offs we saw in 2011 and 2010. There were some very sharp down moves associated with Greece and general debt concerns. Given the environment I'm looking at the moment, I find it hard to see a rerun of that. That's not to say there won't be some volatility, but I just don't think we're going to get really significant negative moves. However, it is prudent to expect plenty of volatility, and in the last week or so I've moved much more into cautious mode. I've been playing the small caps fairly strongly this year, but I am moving to more cautious mode at the moment. And whatever trading techniques you use, they certainly need to reflect the fact that I think the market will be generally rising, but with some possible sharp down periods. So that means that you need to be pretty quick on your feet and you need to be alert to changes in the market. Now typically the US summer months, which really start probably late May, early June, are typically weaker for stock markets. That is not a guarantee. It doesn't happen every year. Probably happens 7 years out of 10. So typically we see very low volumes, everyone goes on holidays, and they're typically weaker. So there's a bit of a roadmap for 2012. I think you can do stunningly well with specific stock selection and a really good trading plan. If you don't have that, then I think you're in high probability of being a victim of the volatility that I'm sure that we're going to get during the year. Now, that covers the technical side of it. I want to now just look at the support functions that a trader needs to be successful. And this is every bit as important as any part of the other side of things. So this is the second part of the trader's edge. So if you look at the learning side, you need to develop a coherent trading plan. And I would, in my experience, hardly anyone has a trading plan and finds difficulty putting a trading plan together. Now, if you get shown the right way, it's actually a really, really simple process, but it's absolutely critical. And I guess what's hard is for most traders that are trying to do this on their own is deciding what's important from the incredible massive information out there that can be A, conflicting, and B, confusing. Sifting through all that and finding out what's important and what you need to learn is one of the more difficult challenges. And so a lot of people kind of throw their hands in the air and give up and just leave it to someone else to do that, and it's not really the way to go. Now, once you've got some learning under your belt, there's then the execution side of it, and the best of trading plans can come very unstuck unless you're very clear about what you're doing and you're very focused when it comes to that execution, and that's something that I spend a lot of time on. The outcome that you want is not a great win that you can brag to your mates about at the bar. The outcome you want is more consistent and confident trading decisions, not this occasional, big U-Butte fantastic winner, because you just don't get that many of them in a year. So it's consistency and confidence that you're really after. So just reflect for a few seconds on what that would be worth to you if you were able to equip yourself to that degree. Now let's have a look at the trading plan. These are the key questions you need to answer. And the first one is you need to be reasonably clear about your life goals. So that's point number one. Secondly, you need to decide what kind of return you want. Now, a lot of people are confused by that question, but you can actually decide what it is that you want to try and make out of your trading. You need to probably get someone to help you to decide whether that's a realistic return given your level of experience. Because unless you've got a fair amount of experience in the market, it's maybe harder to actually determine whether it's realistic or not. You need to decide how much capital you're devoting to the process, how much risk you're prepared to take in each trade and in total. These are all key questions. You need to decide how much time you can devote to the execution of trading and how much time you can devote, or how much time you're willing to devote to learning. What extra skills you need to develop to reach your goals, and there'll be no one that doesn't need to develop additional skills. For me, I've been doing this 25 years and I think my learning accelerates every year. I think I learn more every year than I did the previous year. So if you think that you're skillful and well equipped, then you probably need to look out, because the learning never stops. And you also need to think about what you're going to do with the profits, because you need to have something that drives you when the market is not being kind to you. And there will be periods where the market is not kind to you. So you need to know why you're doing this. Really, really important. Now, there's a basic structure that we take people through, new members through, and what we do is we split the various trading avenues into their individual parts, and we develop an activity target and an outcomes ratio target for each avenue. Now, that's a process that takes quite a few hours, so is obviously beyond the scope of tonight, but it is a process that we go through. So if you don't have one of them, then I can promise you, you are highly at risk in the market and you need to get one. Now, I just want to have a look at some recent trades, and I'll just go through a few of these. We're going to have a look at, these are trades that have occurred over the last few months to perhaps 6 months. So we'll look at a varying number of stocks. Medusa Mining, which is a gold stock, Index. We've got a gas stock in there, a couple of gas stocks, and we've also got a couple of trades that that didn't necessarily work out all that well. So I'm going to show you a few winners, and I'm going to show you a few losers as well. So the first one is MML. Was an entry here at $4.82, and I've marked it up with the actual dates, and these trades are a matter of public record because they went out to the membership base. So entry at $4.82 in early January, we got out 2 weeks later at $5.54. We made 15% gain in 2 weeks. Mightn't seem like a big gain, but again, it's about consistency. It's about getting a high probability of a reward without taking much risk is the name of the game. Next one is Index. It was an entry at $2.19 in the end of January. Had a pretty good run. We got out at $2.68. We made 22% in 4 weeks. So it's just low risk, turn them over. Now here's a losing trade. This is called Blue Energy. It's a gas stock. This was one where I broke one of my rules, ended at 10.5. In hindsight, it was not a particularly good entry point, and you know, I'm still not perfect. I still make the odd error, but as soon as I realised that it was a trade that had gone wrong, I exited at an appropriate point. It represented a 24% loss, but I need to stress here that that 24% loss, because of the way that we actually determine our trade size, that loss was actually way, way smaller than those previous gains. So I do not trade on a fixed dollar amount basis. I use a fixed risk model. Let's have a look at MCE. It was another trade that didn't work out. I played for a breakout, entered at $3.69 on the 9th of March. The breakout failed and we got out with a 9% loss a couple of weeks later at $3.36. Let's have a look at Rock Oil. Ended at 31 cents in mid-January. It had a good run up, started to come back again. We got out at 36.5. As it turned out, the price moved on to even higher levels, but we were able to take a 17 and a bit % gain in a very short period of time. And here's one of the better trades over recent months. It's called New Standard Energy. It was an entry at 39.5, and we made a 41% gain in 6 weeks. Got out when the price started to turn over. So just some examples of trades that we've taken in recent times. Now, just to give you a bit of an idea, my own personal trading of small caps this calendar year, my win-loss success rate currently stands at 74%, and that's a matter of public record. And the prior 18 months, my win-loss record was about 65%. And I make more money when I win than when I lose. So they're very robust stats over the long term. So for me, I'm not looking for major hits. I'm not looking for 200, 300, 400% gains. I'm in there looking to make a gain with the lowest possible risk that I can. Now, I haven't got a lot left to go, but still some very important points. To my mind, I guess you'll gather from what I said earlier, a trading coach is absolutely essential in my view. So I just wanted to cover off how a trading coach can benefit you. The main thing is that it allows you to make more consistent, confident trading decisions and to operate with a much more clarity of thought. And that is the greatest position that you could ever get yourself into. It is far more important than someone giving you a few stock tips. Now, if you're early on and you've had a few successes from a few stock tips, you probably doubt what I'm saying, but believe me, from someone who's been in the market for 25 years, that is far more important than the tips. Because what it does, it provides you with higher probability entry and exit guidance until you can become skilled at it yourself. It keeps you aligned with your trading plan. I see a lot of traders who develop a trading plan and then 2 weeks later they've forgotten all about it and they make no further reference to it. It provides you with assistance on risk management to limit unnecessary losses. It provides a perspective on appropriate exposure levels as market conditions change. There are times when it's okay to be heavily invested in the market, and there are other times when you really should pull back and really cash up. And a trading coach can help you with that perspective. A coach will focus you on learning what is important from the maze of information out there. And finally, help minimize emotional decision making, which is one of the areas where people really do lose a lot of money. So there's a lot of areas where a trading coach can contribute a great deal to you. Now, I just want to go through what it is that we do for those who are interested in maybe considering the next step. So the initial education process, we're running a live trading course on May 11 and 12. So it's Friday evening, May 11, and all day on May 12, which is Saturday. It's here in Perth. It's being professionally filmed and edited, so if you're in the eastern states and you can't make it to Perth, that's fine because it'll be available through the membership portal, which you can either watch in situ or you can download to whatever iDevice you use. Following on from that, there is then a newly developed online supported program that we've developed, and it's basically a series of weekly webinars on each section of learning. So we don't just dump a training program on top of you and leave you to your own devices. We actually step you through that over a period of 3 or 4 weeks, so that we give you the opportunity to ask questions at each stage of that learning. So we want to make sure that you are actually understanding what it is that we're covering. Following on from that, there is a fast-track induction program, and that's basically one-on-one personal coaching from Brett, who has been with me for quite some time, is an experienced trader, and really has his trading activities well sorted out. He provides support in helping you develop your own personal trading plan, and provides a review over a period of a month, a review of the training course, so any other questions that you may have, and how to best use the ongoing services that we provide. So that's the initial education. Once that initial education is completed, then there is an ongoing Insiders Club membership, and that includes daily entry and exit alerts, which come out by email in written form. There are special intraday alerts as appropriate, again by email. There's a monthly skills training session which is held here in Perth. It's called the MUST session. It's conducted live to members in Perth, but it is recorded, and it's posted in the membership section the following morning. There is a trade tracking webinar in between those monthly sessions. So basically every 2 weeks there's an opportunity to be communicating with me on a very one-on-one level. There's email support on your trading. Any question you've got about trading at any time you can send to either Brett or to myself. And there's weekly video updates as well. So that's the Insiders Club membership. In addition, I run another service for more active traders called the Live Trading Room. It's 3 weekly live webinars. They run Monday, Wednesday and Friday at 11:15 a.m. Eastern Standard Time. So it's basically an hour and a half after the market opens. So the market sets up, settles down, and then we go live. So basically you're seeing my screen and you're seeing me identifying trading opportunities in real time. Now, if you can't make that session through work commitments or whatever, it's recorded and it's online by generally about 1 o'clock Eastern Time. There's a dedicated members forum. Every trading signal is sent out by SMS alert, and it's also confirmed on the member forum. And we also run a model portfolio as well. So we're putting our money where our mouth is. We're providing a continuous tracking of trade outcomes, so members can see at any point how we're going and how they're going. Now, the Insiders Club membership, the training program includes obviously the live course, or if you can't attend live, then you can do that online, and that value is $13.95. There is an online supported learning program which is valued at $7.95. Now, we do have a special offer running, so this is not what you pay, but this is what the value is assigned at. There is 1 month of personal mentoring with Brett, so value there of $400. There's a 1 month subscription to the Insiders Club, which is $200. There's a 1 month subscription to the Live Trading Room, which is $450. So if you add all that up, there's over $3,000 worth of value in that initial training and an Insiders Club membership. Now, the special offer that we're making tonight for this launch leading into the May course is at $13.95. So we're providing all of that training and all of that support and coaching and ongoing information for $13.95. Now, the ongoing membership that I described is $200 per month, or it's actually $200 per 30-day period. And if you are interested in that, then we will be sending out this registration link, but there it is on your screen now, specialshareeducation.com.au/May-course. So I'll just give you a moment just to note that down, but we will be sending that out by email very soon. Now, in addition, as you would be aware, there is a free membership competition that we are running. And the inclusions for that membership competition are full Insiders Club membership, as just described, plus we're extending the daily alerts from 1 month to 3 months, plus obviously all of the other support and learning sessions as well. And we're extending live trading room from 1 month to 2 months. We're also adding in some additional private tuition from myself, so that'll be one-on-one as well. So all up, that's the $4,200 that we've been promoting through various channels. So to have a chance of participating in that free membership, and there are 2 of them available, then you need to go to the feedback page, and again I understand that you've probably been sent an email link while this webinar has been in progress, but in any case it's specialistshareeducation.com.au/competition, but you'll probably have that in your emails. And what we'd like you to do is just to leave some comments on what you've learned out of this webinar, and ideally link the experience or your experience and expectations from the market, if you can link that to what you've learned tonight. So we're going to choose the best 2 responses that we get for those memberships. So the best 2 will win the package, and that package is valued at $4,200 each. Now, I will take questions, but just before I do go to questions, the bottom line is this. If you're new to trading, in my view, you absolutely need a coach, and you need a source of consistent, high probability information, because when you're new, it's just really difficult to know what's a high probability trade and what isn't a high probability trade. So you really need someone to help you with that, and consistency of information is important. If you've got experience but you're not getting the results that you want, then hopefully tonight I've given you some insight into a clear alternative. Most traders that I see before I started the business that I'm in now tend to make some money over a period of months or so, and then they give it all back in a few days when the market turns, and I've seen it over and over and over again, and I used to do it myself. So you know, I know how it happens. I've been through all these cycles. So it's because the market has a habit of sucking you in when things are going well. You tend to get overexposed. You tend to get into the more speculative stocks, which tend to run towards the end of the session, and then you get caught out when things turn down. Now, the market makes opportunities available just constantly, every day. But it is brutal on those that aren't adequately trained and prepared, and probably more so now than ever before, because markets are more volatile now than they've ever been before. Our monthly, when you think about it, our monthly subscription fees are no more than what an active trader spends on brokerage every month. So, you know, when you're weighing up the reward for risk here in becoming a member of our organisation, just bear things like that in mind. And if you look at what we provide to you each month in terms of information and services and support, I hope you come to the conclusion that it looks like a pretty attractive proposition. Now, I know that I can help most of you to a very great extent, because I've been doing that with a large number of people for many years. So I hope you give us a try. I don't think you'll regret it. You're not locked into anything. We only prosper if you do. If you're successful, then you continue subscribing. It's just a month-by-month proposition. And I'd just like to finish with saying, what are higher and more consistent profits worth to you? And are you willing to invest a small amount of money in yourself? So I'd like you to contemplate those couple of questions. And just my final thought, whilst the trading recommendations that we put out are really quite robust, my real value to you is the high level of support that allows you to do what's needed. So hopefully with those final thoughts in mind, I'll pass over now to questions. So for those of you that that want to type send a question, just type it into the question box there. Okay, the first question I've got here is if someone who's already retired and needs income from dividends and capital gains, what options have you got? I guess it depends on how you want to mix things up. What I'm addressing tonight has largely been about trading. Now, trading can be done short term, or it can be done more in the medium to longer term, or it can even, go more into the mentality of investing, which is really what you're referring to, Philip, and that's really needing more from income. You may well be better served looking at what we're doing in the investing space, because we've got another whole program which is about investing. So that's not the focus of tonight, but perhaps if you want to send us an email, we can forward you some information on how that investors program works, which is very much geared towards about income and dividends, plus capital gains as well. Now, I've got the question here, what moving averages am I using? Look, I use several different moving averages, but the ones that I was showing tonight are 13 and 26 week periods. So I'm using a 13 and 26 period. So it's either daily or weekly, depending on what chart I'm looking at. Now the next question might be a bit more of a statement. Newcrest is so way overpriced, as is many of the goldies bar a few. Yeah, I probably don't disagree with that, but there are some good ones that I believe are extremely cheap and extremely attractive. Now, there's another question here. What if the time available to me is not consistent? That is, am I likely to miss optimum trades because of unavailability of time? Look, that's a good question, Ken. You can develop a trading plan. In fact, you must develop a trading plan to suit your particular circumstances. So if you have times where you cannot consistently attend to the market, then it's not a difficult situation to construct a trading plan that allows you that flexibility. So it really is all in the construction of the trading plan. You can make it do whatever you want it to make it do. Okay, next question. We're trading, would we use your trading platform or a third party's? Are you recommending CFDs? Okay, good questions. There's two different kinds of trading platforms. One is the actual broking platform that you use to place trades, so you're free to use whatever one it is that you want to use, that's fine. And you're also free to use whatever trading software you want to use. I've used Market Analyst now for a long period of time. It's a good solid piece of software, but look, frankly, I only use a minor part of its capability. To me, I keep technical analysis really quite simple. I don't really care what software you use. If you want to use what I do, that's fine. We're talking the same language. We're looking at the same views, but you're really free to use whatever you would like. And the other question is, am I recommending CFDs? You don't have to use CFDs if you don't want to, but to my way of thinking, looking out over the next 5 years, there's going to be periods where you are only really going to be able to make money if you know how to short sell. Otherwise, you're not going to be doing much, because there's going to be significant chunks of time when the market is going down, and the only real money-making opportunities are on shorting stocks. And CFDs are just an easy way to do that. There are other means, but CFDs are the most flexible. The point I'd make about CFDs is, though, that potentially there's a lot of risk associated with CFDs, but not if you know how to use them. And it's like if you're just learning to drive, learn to drive on a mini minor that doesn't go very fast. Don't try and learn to drive on a Formula One race car. So people that are new go into the CFD market and use a whole lot of leverage and they come unstuck. So if you're new to CFDs, just don't use very much leverage. Just treat them very, very easily. Next question, what type of technical analysis do I use mostly? Well, look, I pretty much went through it tonight, Drew. There's a few other things that I do that takes more explanation, but at the broad level, I pretty much showed it to you. It's all about reading crowd behaviour in charts. I don't look at price charts and just see a whole lot of blue and red bars. What I see is I see shifts in sentiment. So I'm picking reversal points and I'm picking sentiment characteristics that would indicate that the price is going to continue. And the only way that you get to that point is you just got to do it for a lot of years. You've got to do a lot of it for a lot of years. So it's not something that I can teach people in 5 minutes. It's just something that you've really got to have your hand held and experience over a significant period of time. Okay. Now look, I've just got Andre online, and I'm going to unmute Andre to see if he wants to have something to say. Are you there, Andre?
Hi, Gary. Can you hear me?
Yes.
Wonderful. Hey, Gary, just a quick one. I know it's past the hour, and a lot of people will be eager to get back to their families, but I'd just like to thank you for going through that. I certainly picked up on a lot. I'm hoping that the Top Stocks members that are on the webinar with me certainly did as well. I know that your forum is getting a huge following at the moment on our site, and I'd just like to, again, on behalf of the Top Stocks members that are here, to thank you.
Excellent. Thank you very much for those comments, and for those that are interested in what I do, we'd love to continue talking to you, and for those that don't feel they need the support, I hope I've been of great value to you tonight. So thanks all for participating, and we'll see you soon. And just as a reminder for the competition, if you just want to go to that link, which you should have received by email, and if you can just drop your comments there, then you're in the mix for the potential to win those 2 memberships. So thank you very much, and talk soon.